From filling up your gas tank to buying groceries, everything costs more. Meanwhile, the Federal Reserve continues raising its key interest rate.
Just last week, we saw the largest hike in nearly 30 years. But could this be the answer? Our Abby Larico is here to verify. Morning, Abby.
Hey guys, good morning. We've been talking about it a lot, and the term inflation has likely blown up in your vocabulary as of late, with seemingly everything getting more expensive. Recently, there's been a lot of talk about how the Fed is raising interest rates to lower inflation and some concern that they could be going too far.
Let's verify. Can raising interest rates curb inflation? Our sources are the Bureau of Economic Analysis, the Federal Reserve, and American University finance professor Jeffrey Harris.
Baseball cards, cryptocurrencies, all sorts of assets have gone up in price.
He says partially because of economic disruption due to the COVID-19 crisis, and partially due to trade issues with the war in Ukraine. The economy is, quote, overheating. The Federal Reserve Bank of Cleveland explains online that when inflation is too high, the Fed typically raises interest rates to slow the economy and bring inflation down. Higher interest means it's more expensive to take out a loan for things like getting a new car, starting a business, or buying a home.
One way to try to tame that inflation is to raise interest rates. You raise the price of borrowing in the economy to try to cool off the spending that people are making.
So we can verify, yes, raising interest rates can curb inflation, but that doesn't mean it will.
But it's a complex interaction of forces that happen. One of the features that the Federal Reserve tries to assess is whether it's going to slow the economy by too much or by how much. And that's not always a straightforward answer.
So the bottom line is Professor Harris says it's an inexact science, and doing the same thing twice does not always lead to the same outcome. Tony.
It's so complicated. If it's slowed down too much, can raising interest rates then hurt the economy?
That's a big question a lot of people have. So many economists agree that the U.S. is in danger of entering a recession. And of course, the most widely accepted definition of a recession is 2 consecutive quarters of negative GDP growth. The Bureau of Economic Analysis shows the first quarter of 2022 was negative. So will changing the interest rate help us avoid a recession or drive us faster toward one? That is the billion-dollar question.
All right, Abby, thank you very much.